Welcome to another episode of our Capital Ideas podcast, where we get to know the people behind the portfolios. We spend time with portfolio managers and analysts, hear a little bit about them as individuals and also their ideas, lessons learned, their investment edge. Today we have Alfonso Barroso with us. He's been at Capital Group for more than 30 years. He lives in London. He's an equity portfolio manager, and we'll chat a bit about Europe, in particular the banks. Who would have thought over the last year they've done better than the Magnificent Seven? So something a lot of folks might not know, but Alfonso, welcome.
Thank you very much.
So we're going to go way back. We're not just going to jump into European banks. How'd you get here? How'd you get to Capital Group?
I joined in 1994 as part of the Associates program called TAP. It's currently called Capital Associates Program. And it's a program pitched at undergraduates. So I had just finished college and I was considering taking up jobs at a couple of investment banks. But out of pure luck, I came across Capital. They sent me a letter when they were in the Boston area recruiting. And I met just the most wonderful people.
And you were 21 or 22 years old.
That's right, yes. Yep. But I could see myself working with the people. And what sealed the deal for me was I got a telegram, which back then was even like outdated and kind of ancient mode of communication. Yeah. But it was really touching because I got a telegram from the person I first interviewed with, Joe Higdon, very warmly saying that she really wanted me to join.
A telegram. Do you still have that?
I do, yes.
Let's talk about your journey as an analyst. REITs, telecom, retail. Tell us a little bit about becoming an analyst and how that went. And also, I know you like to go and travel and visit the companies that you end up owning. So tell us a little bit about the travel associated with being an analyst.
Yeah, so I was really lucky. Plus, I was just excited to have anything as coverage. So when I was given the opportunity to cover the European retailers, I didn't know much about them, but I was excited. That was
your first coverage.
My first coverage, right. Yes. But it also turned out to be really exciting coverage because back then it was a very large sector and the European retailers were real global champions and pioneers in their sector, especially in food retailing. The Europeans from the mid-1960s had been exporting and introducing the big box format, hypermarkets that hadn't existed. And so while in the US you had Walmart doing that, the Europeans were doing that all over the world during that entire time Walmart was doing it. So I had opportunities to travel all over the world following what they were doing. One of the earliest and most fun experiences I had was going to Brazil just after the tail end of the hyperinflation period, and walking into the store and just being greeted by whirls of people on roller skates and ticker tapes, adjusting the prices because inflation was so high that they'd have to adjust the prices.
Live time, just during the day they were changing the prices.
Yes, so on roller skates, and you'd see people following them and chasing them to grab the goods before the items were repriced in front of their eyes. So it was really fascinating time to see how retailers adapt to that kind of environment.
And this was late 90s.
This was late 90s, yes. It was 1997 or so.
Got it.
And it also was a good springboard for me to pick up coverage of the European, Latin American retailers. And that was my second coverage, was extending my coverage to that area.
I want to take that and figure out how we get to Soviet Union post-collapse mines, because we have a picture of that, and it's behind us for those listeners. It's a very young Alfonso. Not that you're not young now, but you're much younger, and you're in a blue suit. You either look like you're on the run, or I'm not sure where you are, but tell us about this experience, because again, you like to go and kick the tires of the companies and industries that you see. Tell us about the picture.
So this trip was actually my first research trip ever, and it was before I had the analyst coverage. This was when I was still in TAP, and it was a research assignment I did on former Soviet Union mining companies. And the thesis at the time was that this was just 2 or 3 years after the collapse of the Soviet Union and of companies having independence. And the thesis were that these areas were incredibly resource rich, but had been underinvested, and these countries needed foreign investment to come in. So on this trip, I went with the European Bank of Reconstruction and Development to Tajikistan, where we met the president, who was a very young 42 years old, and his whole cabinet looked very young. So that was a really interesting experience. And in fact, I looked up today, he's still the president. So he's the seventh longest serving president or prime minister of any country
Wow.
around the world.
So in his 70s now, whatever,
Yes,
close.
yes. I got to visit a really cool open pit gold mine. So it was really fascinating to see that whole process, to be able to touch and feel it, and then to also see that it still exists today. It's now part of one of the largest mining companies in the world, based in China. So fascinating to see that
Yeah,
history.
you probably didn't think when you had that telegram arrive from Joe Higdon that a very short time later you're going to be looking at old Soviet Union territories and mines.
Yes.
That's pretty cool. I ask every guest the same question. Everyone's got a little bit something different that they do that makes them unique as an investor. So what's your investment edge?
Well, I'll highlight two. The first one is that I think about downside as much as I do about upside. And that's typically the very first thing I will ask myself about a stock, is I'll try to get a sense of how much downside is there in the stock. And then, only then, I will start to think about the upside. Some of my biggest successes as an analyst and as an investor has been in avoiding blowups. When I followed tech in the TMT period, those were some of the best years I ever had, because I held very little in technology. And when everything rolled over, I did very well.
Because you saw the downside risk greater than the upside opportunity.
Yes, and I couldn't make sense of what I was seeing. And I even had developed a recommendation to take pressure off of myself. My recommendation for stocks that were IPOing and that had a lot of frenzy around them was buy at your own risk. And that tended to keep portfolio managers away.
I'd say so. You're basically saying you're going to underwrite it because I'm not.
And then also, when I was following the real estate and REIT sector, I was also following it just before the global financial crisis. And at that point, real estate was also very ebullient. Cap rates or rental yields were at all-time lows, and they were using a lot of debt financing, and it didn't make sense to me. And I just felt I don't need to hold these stocks. And again, that was a period that really stands out of particularly strong results for me.
You're in London, and I want to get into talking about London. I want to talk about Europe, but what's the advantage for being based there locally?
So the first thing for me is that London turned out to be a terrific place to spend my second year at Capital when I was doing my research assignment, because that's where I met my husband. So I've been together with him for almost 30 years now.
Congratulations. 30
Thank you very
years.
much. Yes. London is one of the financial centers of the world. Companies, regulators come into London, and there's very easy access to all of the financial information and companies that come and visit. And it's also very easy to travel around the world. So it's a great hub for the investment community.
I started off by introducing the concept of these European banks just getting into the markets now, and just remarkable share price performance over the last year, anywhere from 50 to 100% higher in the revaluation of a bunch of these banks, from being sub book value multiples to being book value or higher. What happened, and where do we go from here?
Two main reasons. The first is after about a 10-year period of disinflation and deflation in Europe. This is after the European sovereign debt crisis that ended around 2012, 2013. There have been periods of mostly negative or very low interest rates in all of Europe. And if you're a bank, it's very hard to make money if interest rates are zero or negative. And when you cannot charge your customers negative deposit rates. So when savers have their money with you, you're actually burning a hole in your pocket as a bank. Just after COVID, and with a lot of government stimulus to revive the economy, inflation came back and interest rates started to rebound for the first time ever. And now we've gone, for example, in Germany in 2022, The 10-year was at minus 50 basis points, and it's now 240 basis points. That's a very dramatic move. And with that, bank profitability has come back very strongly, and bank ROEs have also come back very strongly. The second reason that they've done very well is that the regulators, the ECB and the national bank regulators, have allowed banks for the first time since the European sovereign debt crisis to distribute excess capital back to shareholders. So if you might remember, in the U.S., the Fed allowed U.S. banks to do this in about 2013, 14. Is banks that had excess capital could distribute those back to
So
shareholders.
stop having to build such strong balance sheets to make them even safer, return some of that excess capital to shareholders.
Yes, yes. So that happened in about 2022, 2023. And so it allowed the banks to pay more dividends, buy back shares. Also, it allowed banks to pay higher proportion of their net income back to shareholders, such that you didn't have just a cheap bank on price to book, but you also have banks now that are generating significant dividend yields and are also retiring a lot of equity and buying back shares. So you get that whole machinery of faster earnings growth and also higher dividend yields.
And a little fiscal stimulus too, instead of fiscal repression, with some of the things that are happening with the US with tariffs, causing Europe to have to own its own energy independence, own more of its defense independence. That's causing some additional economic activity. You think this continues, or this revaluation that we're seeing?
It has a possibility to. So the valuations have re-rated from roughly 7 times forward earnings to 9 times. And the price to book, as you were mentioning earlier, has re-rated in the past 12 months from 0.8 times to 1.2 times. And this is still about a 30% discount to the U.S. And over long periods of time, it's at a small to modest discount to where it's traded in the past period. So I think there's a potential for the banks to re-rate another 20 or 30%, but there are also risks going the other way.
Europe, there are always regulatory risks for sure. What else do you like in Europe?
So one sector I like are industrials that have been in tough end markets, and there are a lot out there. We know in the U.S. and globally that there has been a surge in CapEx and data centers and in AI. But outside of those sectors, much of the industrial global economy has been depressed in levels of CapEx and also industrial end demand. And one of those areas are industrial trucks and commercial trucks. And 2 companies that I like that operate in that sector, one is called Volvo. They are Volvo AB, not the car company, but the truck company. They are one of the largest heavy-duty truck companies in the world. They compete alongside PACCAR. And it's a very attractive, very consolidated, rational industry. And they've had very tough to little volume growth over the past couple of years. And margins are depressed, and the valuation is also a bit in the doldrums because no one really cares about companies that have been in 2 or 3 years of very little earnings growth and earnings revisions. So it's trading at a very attractive valuation, low teens, PE, 4 or 5% dividend yield, no industrial debt on their balance sheet. And another company that is in that same value chain is Michelin, which is a tire producer. And most of their profits come from heavy-duty trucks. And for the same reason, they have had very weak demand, and their margins are depressed, and their valuations are also depressed. They're large companies, but they're not mega cap companies, and they're easy for people to ignore. And I think that's one of the reasons I can identify value in pockets like that.
And so you got to be patient, right? Because the markets aren't rewarding them yet for what you see coming in the next 5 to 10 years.
Yes.
So how patient are you as an investor?
Yes, it requires a lot of patience. So these are companies that I both invested in a little bit early. So they haven't been the best stocks over the past year or so. I thought I was investing in them already a fair way through the tough period. But it's part of what makes us special as an investors and as a company is the ability to be patient. So I've used these as opportunities to add more. And while I wait, I'm getting paid a 4 or 5% dividend yield.
Getting paid to wait for that revaluation theme.
Yes.
Got it. All right. One of the other roles you have, and you have a lot of roles at Capital Group, is you're a balanced portfolio manager, which means you manage both in stocks and bonds. Talk a little bit about that remit you have, because that's a pretty big remit. Both universes are incredibly broad. How does it work in practice? How does it work every day?
Yeah, so what the role of the balance manager is really meant to do is to have someone that can look at the entire capital structure of the financial markets. So to have that complete view from companies that need to issue debt, how that relates to sovereign yields, how that relates to capital structures of individual companies that we hold in our equity portfolio, and to calibrate the relative risk and reward. So an important part of being a balance manager is being able to flex where we see the best relative risk and reward. But beyond that, what's most important is being able to connect those dots and bridge together opportunities, because there are many equities that are fixed income like a utility, and you have to have a good understanding of how that relates to where interest rates are. And you can have fixed income that is equity-like a high yield bond company that has a lot of debt and is trading at widened spreads. And then sometimes those high yield bonds can be more attractive than the corresponding equity. So being a balance manager gives you that ability to identify opportunities in a way that otherwise might be more difficult.
And how do you work with your fixed income colleagues? Because clearly you're a subject matter expert in stocks. They're subject matter experts in bonds. You have one of the few mandates at Capital Group where you have to look across both. How do you work with them as subject matter experts in their space?
We have weekly calls between some of the fixed income managers and I, and then monthly we have a global call of all portfolio managers in the fund, whether they're the dedicated equity managers, the dedicated fixed income managers, and we all go around the room talking about what we're seeing in the markets, where we see relative value. In addition to that, we also have a structured quarterly call that's called a global asset allocation call that gets together all of our subject matter experts, whether it's in macroeconomics, the political economy, fixed income, equities, and we talk about what we're seeing. We also have, as you probably know better than I do, we have a very well-developed quantitative risk and assessment group now, analytics group, and they provide a lot of information that gives us quant insights into the various asset classes.
So you get all these pieces of the puzzle together, and it helps you make better decisions by understanding the whole.
Absolutely.
Effectively.
Yes.
Where are some of the lessons you've learned that didn't work out so well? And every one of our investment professionals tells me there's many. We're a very self-deprecating, humble group, but maybe pick one or two on a lesson learned.
Right. So one, and this is to show that I don't always avoid blow-ups. I had a blow-up early on as an analyst, a company called Ahold, which operates the Stop and Shop and Giant brands for those in the U.S. who know it. And then in Europe, they have the Albert Heijn brand. But they're one of the largest supermarket retailers in the world. And I had recommended to invest in the shares in the late 90s because the valuations were pretty moderate at the time. They had a long history of steady growth. They paid a good dividend yield. The company in 2020 bought a company called U.S. Food Service. They expanded into a slightly different industry. And it was a relatively modest acquisition. And most people said, well, this is a bit weird, but
it'll be fine.
It'll be fine. It turned out to not be fine.
Not so good.
A year afterwards, they reported that there was accounting fraud in the division. And in the course of 2 days, the share price fell 50%.
Wow.
And then it fell 50% again and 50% again.
And this is in a short period of time.
This was all of that happened in the course of a month. So after a month, it was down 80%, the share price.
Right, which is challenging to say the least. So how do you react to that?
Well, after I cried for 2 days and thought I would lose my job,
right.
One of the lessons I learned from that is balance sheets are incredibly important. Partnering with our fixed income analysts is very important, which I did. And is a lasting lesson and investment edge I feel like I have today. I worked with our fixed income analysts at the time. We did an assessment. We both bought the bonds in the stock because they were traded at very low levels, and they had equity-like returns. And I also bought some of the equity in addition to that, which helped. It didn't completely make up for the big losses, but it helped defray it, and it's seared into my mind and has become seared into my investment process in terms of the importance of the balance sheet,
Liquidity.
and liquidity, and accounting, and having the fixed income counterpart at your side.
That makes sense. All right, let's pivot and do the treasure hunt. So the office treasure hunt, for those who might be new to our podcast, the reason we do the office treasure hunt is if it's in your office, it must mean something to you. And part of this podcast is to get folks to know our investment professionals. They're all unique. I think they're all special. So in your office in London, where I was very recently, there's a dog with a bone. And for our listeners, I'm going to hand it to you and ask you to read what's on it and describe why it's in your office and why it's important to you.
Okay, so it says best 3-year income growth 2016.
Best 3-year income growth. Okay, tell us more.
Yes, so I'll give a little bit of history behind dogs. In the investment group I work in, Capital Research Global Investors, we have a forum called Yield Dogs. It goes back to the mid-1990s when we were all part of one organization, and we had something called Yield Hogs. And this was for a group of funds that had income as an important objective of those funds. And it kind of says what it symbolizes. They were for ideas related to high income. As we grew and expanded our group, we then had forums called Yield Hawks and Yield Dogs. And in my unit, we came up with Yield Dogs, and it means something that is beyond just something fun and that we can show pictures of each other, but it means dividends ought to grow. And what that really means is that a high yield by itself doesn't necessarily mean it will be a good investment, and you can lose a lot of money. So the ought to grow part means that the dividend has to be sustainable, and it needs to grow. And that is the emphasis. So we were having an annual Euro-focused trip where all of our analysts and PMs come together globally to meet companies in London. And we did a side session for dividends ought to grow and for the funds that need income. And this wasn't a pre-planned contest. It was just something for fun, just to remind us that the growth element matters a lot. And the fun thing with this is that every year when we go meet companies, we always bring a little mascot of a dog, and we remind them that we expect them to grow their dividend.
Dividends ought to grow. I love it. We make an acronym out of anything.
Yes.
And so you were the winner of the Yield Dog. Let's talk a little bit more about the Capital Group community and how we travel together, because I think that's part of the secret sauce of Capital Group. I think the statistic is that in 2024, we had done something like 21,000 company meetings at Capital Group. And in 2025, the number would be probably the same or slightly higher. So we like to travel together. We like to build community. You did a tech trip, and maybe talk about TechZep. It was in Japan, but again, 20-something years ago. I think we have a picture of that. We do. I'd ask you just to describe the picture, where you were, and how important it is to build that community when you travel together.
Yeah, so this is a really great photo and great history for me, because it's September of 2001 in Japan. TechZep is a forum that was created in the year 2000, just when the bubble in tech was forming. It was under the guidance of Don O'Neill, who you see wearing the glasses there. And this was one of our first ever global research trips together as that group. And it included the entire value chain of TMT at the period. People who were in telecoms, people who were in the tech and media, chips, chip design. And the NASDAQ or the S&P had already declined about 20% at that period of time. So there's already a little bit of worry, like what's going on. And the value of having us together at that trip is we were kicking tires, we were talking about ideas just in that important period of time. And just afterwards, September 11th happened. The S&P fell another 20% the week after this trip.
Well, this was a week before 9/11.
Yes, it was. Yes. And then over the course of the next year, it continued to decline such that the S&P had fallen by 50% and the NASDAQ by 80%. Having this group together and the camaraderie, the sense of being a team was incredibly helpful during that period of time. And one of the incredibly special things is just to look back at how many of those associates are still with us today or spent their entire career. Maybe they're retired, but they spent their entire career. And to the long-term perspective of capital, it really shows that most of us would have had really bad results by the
During
nature
that
during that
period.
period,
Yeah.
by nature of the coverage that we had. But just because of our culture and our long-term orientation, we've all been very highly successful investors. And in that list of folks that you see are some of our best investors today.
It's a great story of camaraderie and also how you lean on each other during some of the harder times. Let's just pivot to mentors before we finish up here. Name a mentor or two that's been impactful in your 30-year career. And I know it's hard because there are so many, but maybe just pick one or two.
The first one is Jim Lovelace. So he's been with the company for 43 years now. He's the longest CG tenured investor, and I've worked with him for most of my career. He's an incredible investor. He's very patient. He has low volatility. He does well in down markets, and I've had the pleasure of following his mentorship over most of my career.
And Jim, low volatility, low turnover, value investor at heart, and has done exceptionally well over his 43 years at Capital Group.
Yes. The second one is Ann Vendinabili. She is a macroeconomist, and she is chairwoman of the Capital Strategy Research Team. She joined that group when it was a group of 6 or 7 in 2003, and she's helped lead that group to 17 today. That includes political economists, macroeconomists around the globe. Yep. And she was the first person to have dedicated non-U.S. coverage at the time. And so just to see how she's, along with others, have built the team to where it is today, and to see her curiosity in people, intellectual curiosity, and how she helps the team bridge together macroeconomics in a way that is relevant and very impactful to investments is something that I admire greatly. And she has also been a good friend.
Yeah, she's incredible. That's good. And she's in DC now.
That's correct. Yes.
That's right. Okay, we're going to finish up with a moment of gratitude where I'll share with you this Be Obsessively Grateful mug. And again, just for context, the reason we say be obsessively grateful is at times society can lack gratitude. All of us are in society and we're guilty of the same thing. So this is just an opportunity as I hand you the mug to tell us what you're grateful for. Anything, personally, professionally.
Okay. Right.
Go for it.
The first one is Capital Cares, which is an incredible program that is associate-led, that encompasses charitable giving and volunteer work. And 67% of all of our associates globally in 2024, that's 6,300 associates, I believe, participated in one of the programs, with donations reaching $50 million and over 5,000 nonprofits. That's incredible. So I just have to say a huge thank you to all of our associates.
And I think the stat, you may know, but I think the stat is over 10 years, Capital Cares has given away through the program about $350 or $375 million in total.
Yes,
which is amazing.
That's right. That's correct. But just to see how many associates participate in it, so I have to give a huge shout out to all of our associates, and a big shout out to 3 people that have inspired me in particular over the years. One is Victoria Brown, who works in research services in London. Dana Farisian, who is in global investment control, and Maeve Murray-Smith, who helps run the program. The second area of gratitude that I have to say, because I work a lot with these people, is our investment and enablement team. And these are subject matter experts who bridge together all of the governance and management groups within the investment group, and makes it all happen. And without them, I don't think we could function, but I've worked so closely with them, and 2 people in particular that I've worked with a lot are Justin Hutchings and Tracy Purdue. So big thank you to the both of them and the rest of the team.
I'm glad you used both of those examples because capital cares and how people lean into community and invest in the community, both inside and outside of Capital Group, and try to share their resources, whether it's time or money, to help others. Super important culturally at Capital Group. And then you calling out folks in investment enablement is so important because it's one Capital Group. We talk about one CG. And yes, you may be a portfolio manager who manages billions of dollars and has been here 30 years, but the whole ecosystem at Capital Group helps make everything work, helps the success that we generate for our clients. So I appreciate you calling out both those groups because they're both super important to what we do. I'll also thank you for being on this episode, sharing some of your wisdom about Europe, your history as an analyst and a portfolio manager. And we're just grateful that you were able to join us. So thank you.
Great. Thank you.
All right, everybody. We appreciate you joining. Have a great day.